If you have opened your portfolio in the last few weeks and felt your heart sink, you are not imagining things. Indian IT stocks have been falling continuously. Not just one bad day, but week after week. And even on 12th of Feb, Nifty IT fell more than 5%. So the big question is, what is happening? Is it bad earnings? Is it global slowdown? Or is it panic? The real reason is much deeper. And that's what this short story is about. First, let us clear one thing. This is not just India problem. Indian IT companies earn their revenues mostly from the global companies, especially United States. So when the global technology stock falls, India feels it immediately. Yes, interest rate matters. Yes, US economic data matters. But these are just the triggers. The real story is about how IT works itself is changing. For decades, India IT followed a simple formula. More people, more work, more billing, more revenue. Global companies outsourced coding, testing, support, maintenance, back office work. So India IT became very good at scaling. Large teams, large contracts, and predictable revenues. And this model worked beautifully for years. Investors loved it because it felt safe. But every successful story reaches to a point where the rules begins to change. And that turning point is artificial intelligence. Not AI as a chatbot, but AI as a worker. And this is where the Anthropic enters the story. In the late January this year, Anthropic, the company behind the cloud, introduced the tool that can actually do the office work. Not just answer the questions, but handle documents, workflows, and routine tasks. For investors, this was a wake-up call. Because suddenly the question became, if AI can do the same work with fewer people and less time, what happens to the business built on billable hours? That's when fear entered the market. And markets don't wait for the damage to happen. They price future risk. Well, investors started thinking, same output with fewer people will generate less billing. And that's why IT stocks didn't fall because of just one bad quarter. They fell because the future math has changed. This wasn't the panic selling, it was repricing. Well, another shift is happening quietly. Earlier, client used to ask, send us 50 engineers. And now they ask, give us automation, AI, and outcomes. So the focus is heavily moving from people to technology and effort to solutions. This transition is uncomfortable, but, unavoidable. Well, I'm not giving you any stock advice, but let me give you some insights for the companies which are adapting faster. Companies like TCS and Infosys talk a lot about AI platforms and transformation deals. Companies like HCL Tech and LTIMindtree strongly focuses on engineering, cloud, and AI-driven work. And names like Persistent and Coforge are often seen as more flexible because much of their business is already digital. So what is the common thread here? Well, they are not asking how many people we can deploy. They are asking how do we solve the problem smartly. So this fall in IT stocks doesn't mean Indian IT sector is finished. Well, it means easy phase is over. The next phase will reward adaptability, technology focus, and smarter delivery. Volatility will remain, fear will come and go. But Indian IT has reinvented it before and it may do so again. So let me ask you, do you think Indian IT can adapt to this AI first world? And which company do you think are moving in the right direction? Tell me in the comments. See you in the next video. Bye for now.